Hello to anyone that is listening. This is Mahiev. I'm going to present the final project. We called it the RL approach to index replication. We did this in collaboration with Laurence and Erfan. So the motivation behind index replication is that investors are often seeking investment vehicles that are decorrelated with the stock markets. We call those alternative investments. They include, for example, real estate and commodities, and there are many more examples. So like I said, the motivation for an investor to have alternative investment is that it's going to reduce the risk of your portfolio because it is decorrelated with the stock markets. The problem with such investment is that they are often difficult to access and they're not very liquid. Take the example of real estate. If you wanted to have exposure to this type of investment, you would need to buy property. So it's not liquid, like I said, and you need to be wealthy to invest in property. A solution is to instead try to use liquid assets to replicate the returns of an alternative investment, like real estate, like commodities, or something else. So what we tried is we have a baseline. It's based on a particle filter, and actually there's an article for this. It's an article from Roncailly, and it is listed in the references of our report. On top of that, we tried three reinforcement learning methods: actor-critic, proximal policy optimization, and reinforced algorithm. So problem formulation. The data that we used, we scraped it on Yahoo Finance, and since this is a proof of concept, we used the S&P 500, and we also had a basket of 15 assets that we also scraped on Yahoo Finance. So the action at each time step in this case is the weights that we're going to invest in each asset. So it is represented by a vector beta 1 to 15 because there are 15 assets. So this is our action. And then we denote R as the vector of the returns for each asset at time t. The base case that we describe in the report is actually simply the difference between the replicator portfolio and the index return. And our replicator portfolio is simply the action that we took. It's a dot product between the action and the return vector. And again, in the base case, the reward function we use is simply minus the absolute value of the difference between the returns of the portfolio and in the index. So this means that the highest reward the agent can get is 0. And as soon as it is different from the index, it will be penalized. I'm not going to go in the details of each experiment because you can get more details in the report, but we tried 3 different experiments. The first one was to add a penalty on the cumulative return. The second one was to add additional observations. And then the third one was to add a penalty on turnover. These are the results that we got, and actually the one thing that is the most important to notice about this is that the particle filter outperforms by far any of the RL methods. This is a visual explanation of the tracking errors that we got. So the blue line here is actually the index, so this is the S&P 500. And you can see that the particle filter is actually tracking it quite well. In red and in green, we have the actor critic and PPO, who are actually doing quite well, but sometimes there is a big spread. And finally, we have the reinforced method, which in this particular case is not doing very well. So to conclude, we presented RL methods to replicate the returns of the S&P 500 index. The particle filter still outperforms RL agents by far. There are many improvements that we could do For instance, we could try recurrent neural networks to grasp the context of temporal data, and we could do more hyperparameter tuning. So thank you for listening and stay safe.